we have talked about held to maturity securities. Now let's look at trading securities and available for sale securities. Trading securities, as we mentioned, those are investment actively managed in a trading account for the purpose of profiting from short-term price change. And securities are available for sale. Those are under those situations, investors, they do not plan to trade the investment actively, but investment is also available for sale given the right condition. So as we mentioned, if that security is classified as either trading security or available for sale security, they're reported on the balance sheet at fair value. So as for the accounting treatment, how are trading security and available for sale security different from held to maturity security? The major difference of trading security and available for sale security from held to maturity, that is the fair value adjustment. So whether we need to worry about the change in the fair value of the security. And how is trading security different from available for sale security? So how are those two methods differ? For trading security, the unrealized holding gain or loss or the change in fair value, those goes into your income statement directly. So those impact your income statement directly. They go into your net income versus available for sale security. The unrealized holding gain or loss, they go to OCI, and then eventually it's going to go into your accumulative as a comprehensive income. So why do we treat unrealized gain or loss differently under these two situations? Please take 1 minute, try to think about it, and you can pause your video for now. So why do we treat unrealized holding gain or loss differently under these two situations? Because if the security is only available for sale, we are not actively trading the security, including unrealized holding gain or loss into the net income. That will make our income appear to be more volatile than it actually is. So because we're not really trading it actively, so there's really no need to make if we're included into our net income will be very volatile, because if you think about market price change all the time, which means every time, like every reporting period end, we need to make some fair value adjustment because of the change in market price. And because we're not really actively trading those security, it's really unnecessary to make our net income look so volatile than what it really is. So that's the reason we're accounting for available for sale security a little bit differently than trading security. So to put our unrealized holding gain or loss into OCI instead of net income. And then as for the specific journal entries for trading security and available for sale security. So first of all, when we purchase those debt securities, the journal entry is the same as held to maturity. And then the second journal entry is when we receive interest payment. So that is the same as held to maturity as well. And then the third journal entry is change in fair value. So if the security is classified as held to maturity, we don't need to worry about this, the change in fair value. However, if it is trading security or available for sale security, we need to worry about the change in fair value. Specifically, if it is trading security, the journal entry is to debit unrealized holding gain or loss on trading security. So if it is a loss situation, we need to debit unrealized holding loss on the trading security, and that is goes into net income, and we credit fair value adjustment. So because this is a loss, meaning that the fair value is less than the book value, the net book value before the adjustment, we need to credit fair value adjustment this fair value adjustment, it will decrease our investment account. And if it is the gain situation, we need to credit unrealized holding gain on the trading security, which is a net income account, And then the fair value adjustment is the difference between the fair value at the time of adjustment and the net book value. So this is for the trading security. And for the available for sale security, the only difference actually is instead of debit unrealized holding loss on trading security, we now debit unrealized holding loss on available for sale security, which is OCI, which is as a comprehensive income account. And then if it is a gain, we credit unrealized holding gain on available for sale security, on available for sale investment, which is as a comprehensive income. So, and then the fourth journal entry is for when we sell the security. Now the trading security and available for sale security is also a little bit different. Let's look at the trading security situation first. So when we sell the security, there are actually two steps here. The first step is we need to adjust the investment to fair value. So at the time of sale, we need to make fair value adjustment first. Depending on whether it is the gain or loss at the time of sale. If it is the loss situation, we need to debit unrealized holding loss on trading security, which is a net income account, and credit fair value adjustment. And then the second step, we need to remove the investment, any discount or premium, and the fair value adjustment. So we need to, when we sell the security, we're getting cash. So we debit cash. And then we need to remove the investment account. So this investment account, including the face value of the investment, any discount or premium, and the fair value adjustment account. So all these three accounts, those belong to our investment account. And is there going to be any gain or loss here? Please take 1 minute, think about it. Is there going to be any gain or loss here? And you can pause your video for now. So the answer is there is not going to be any gain or loss. Why? Because in the first step, we already adjust the investment to its fair value. And then so the cash we receive, if this is a fair transaction, the cash we receive should be equal to its fair value. So there is not going to be any gain or loss here. So this is for the trading security. And now let's look at the available for sale security. For the available for sale security, when we sell the security, there are actually 3 steps here. The first step is we need to adjust the investment to its fair value. So this is very similar to the trading security situation. We debit unrealized holding loss on available for sale security, which is as a comprehensive income account. We credit fair value adjustment. So this is the loss situation, step 1. And for the step 2, we need to reverse the any previous fair value adjustment. So we just need to, no matter what the balance is after step 1, we need to reverse our fair value adjustment account. So if the fair value adjustment is at the credit side, the balance, we need to debit fair value adjustment, and we need to credit reclassification adjustment, which is as a comprehensive income account. And then step 3, to remove investment discount or premium. So now we don't need to do anything regarding fair value adjustment because it is already removed through step 2. But we do need to recognize any gain or loss from the sale. So here is the journal entry, debit cash because we receive cash. Write off all of the investment account, anything which relate to this investment account. And then we need to recognize any gain or loss to balance. And so here, in essence, what we are doing here is actually we are trying to take out any of the fair value adjustment which previously going to our AOCI as accumulative as a comprehensive income, and to reclassify them into our retained earning eventually. Because if you look at this, by reverse the fair value adjustment and to reclassify it into OCI. So this is actually going to impact our AOCI, right? So anything which goes into OCI is eventually going into our AOCI after the closing of our book. And so the unrealized holding loss was previously, it was debited into OCI, which is like debit into our AOCI. And here we'll credit it out of AOCI. So it will reclassify it. We'll take out all of the previous fair value adjustment out of AOCI. And at the time of sale, we're taking them out of AOCI and to reclassify them into retained earning. So reclassify into retained earning. So this is eventually what we're achieving through taking this extra step 2. And then in step 3, the gain or loss is going to be recognized because those unrealized gain or loss eventually, so they are realized now. And then that's when they can go into our net income versus the trading security. Every period, the change in the fair value is impacting our net income. And for available for sale security, where netting those change in fair value impact our net income at the time of sale instead of every period. So every period, they're only impacting our AOCI, our other comprehensive income. And then at the time of sale, we'll classify them out of our AOCI. And then now they can impact our net income at the time of sale. So this is the subtle difference between the trading security and available for sale security. Now let's look at an example. So let's continue the previous example. If for this debt investment, where account for it under the trading security, what are your journal entries? So please take 10 minutes, try to work on those journal entry. And also please write out your journal entry under available for sale security. And you can pause your video for now. So under the trading security, and available for sale security, when we purchase the bond investment, it's actually the same as held to maturity. So we debit investment in bond for 1 million, credit cash 885,301. And because in this situation, we have a discount of bond investment, so we credit discount of bond investment. So same as held to maturity. And at the end of June, we're receiving cash interest. And then the journal entry we make is also the same as held to maturity. And then at the end of June, so we have a change in fair value as well. And if the bond is classified as held to maturity, we don't need to do anything here. But if the bond is classified as trading security, we need to calculate what is the change in fair value. So the net book value at the end of June 30th, what is our net book value? So if you go back to look at our amortization table, on June 30th, the net book value is so that is 888,419. So that is basically we take the face value of 1 million, and we take out the difference between, so we take out our new discount, which is discount on the bond investment, which is 111,581. So so that is, sorry. And now the fair value of the bond is 850,000. So the fair value is lower than the net book value. So we need to write down the net book value to its fair value. And the difference between these two is 38,419. So that is the difference. So we need to, because we need to write down the net book value to fair value. So that is a loss to us, unrealized holding loss on trading security, which goes into our net income, and credit fair value adjustment. So fair value adjustment is part of our investment account. And by credit fair value adjustment, we're going to decrease our investment account, the net book value of the investment account. And if it is available for sale security, the only difference here is we debit unrealized holding loss on available for sale security, which is as a comprehensive income, and credit fair value adjustment. And the last date is July 1st, when we sell the bond. So we sold the bond for 860,000, which is the fair value of the bond at the time. And if it is a trading security, we have two steps. The first step is to adjust the investment to its fair value at the date of sale. And so the previous step, we already adjust the date to its fair value at June 30th, which is 850,000. And now we need to adjustment to 860,000. So after 1 day, and then so this is an increase. Now the change is 10,000. So we need to mark it up by 10,000. So that is debit fair value adjustment for 10,000, and credit unrealized holding gain on trading security, 10,000. And then the second step is to write off, to get cash and to write off the investment from the firm's book. So we receive cash 860,000. And now the net book value, because we already made the fair value adjustment. So now the net book value of this investment is exactly 860,000, which equals to its fair value. So we credit. So there are three accounts which relate to this investment. The account which records the face value of the bond investment. Well, we have an amortized discount on the bond investment, and we have a fair value adjustment account. All of those three accounts, which are part of this investment account, and we need to write off all three of these accounts. So the investment in bonds is 1 million. The unamortized discount on bond investment is 111,581, and the fair value adjustment. So the initial fair value adjustment is at the credit side of 38,419, and then we debited it for 10,000. So the remaining balance is at the credit side of 28,419. So to reverse this amount, we need to debit fair value adjustment for 28,419. So this is our second journal entry for trading security. And if this debt security, it is classified as available for sale security, we have 3 steps. The first step is, so we need to mark it to its fair value first. And because it's available for sale security, the first step, we debit fair value adjustment for 10,000 and credit unrealized holding gain on available for sale security, which is other comprehensive income. So this is the first step. And for the second step, we need to reverse all of the previous fair value adjustment. So as we just said, the balance for the fair value adjustment is 28,419. To reverse this amount, we need to debit fair value adjustment for 28,419 and to credit reclassification adjustment, which is OCI. And then in the third step, we need to remove all of the account which relates to this investment account. And because we already removed the fair value adjustment in second step, we don't need to worry about this account in the third step. So we record cash, 860,000. We remove the discount bond investment of 111,581. And we credit investment in bond of 1 million. And this journal entry doesn't balance. The imbalance is 28,419. So which is loss sale of investment. So which is an income statement account. So this is the journal entry we do for the sale of the security if it is classified as available for sale.